Hi everyone, happy Monday.
Hello.
Welcome to this webinar co-hosted by AmCham and Choose Paris region. So we will just wait a few moments that uh, participants connect and we will start very quickly. Maybe in the meantime, just to let you know that this webinar is recorded. It will be accessible afterward. And of course, you can comment and ask your question in the chat. We will take 10 minutes at the end to answer it. So please don't hesitate to let us know why you are here today and what you're looking for. And we will start in a few moments. Hi, I'll check see if it's working. Um, okay, so I think we can go. So the goal today is to keep you updated about the French tax regime and accessible incentives. So we designed the presentation for US companies that are either looking to open a French entity in France or that have already opened one. And today we are honored to receive, oh, sorry, to receive Regis Houriez and Carmen Encarnacion Barbosa, tax experts at EY. Regis is also a board member at the AmCham, and they will share their expertise later. I don't know why I keep going on screen. And I'm Cécile. I'm in charge of helping US company for Choose Paris region, and I let the mic to Zaira and Sandrine for a word of introduction in English and French, but the whole webinar will be in English. So Zaira.
Thank you, Cecile. Hello, everyone. So I am Zahira Nouleb Ben Abdallah. I am the Membership and Communications Manager at the American Chamber of Commerce in France. I'm delighted to welcome you all to the second edition of the Club USA, organized in partnership with Choose Paris region, on the topic how to master the French tax regime and incentives. For those of you who don't know the AmCham, as you can guess, our main goal, our main mission is to foster business relationships between France and the United States and to promote France's competitiveness and attractiveness. Therefore, the tax issues are at the core of our discussions and publications. Feel free to reach out after the webinar to me or to Zachary Pasco. I think he's online with us today. I will be thrilled to answer any questions regarding the AmCham activities. Thanks again to Regis and Carmen for sharing their expertise with us today. We are very happy to have you. And thank you all for your attention. And Sandrine, the floor is yours.
Merci Zahira. Quelques mots en français à destination des dirigeants francophones. Donc bonjour et bienvenue dans ce webinaire organisé par Choose Paris Région en partenariat avec l'AmCham. Donc pour ceux qui ne nous connaissent pas, Choose Paris Région est l'agence d'attractivité internationale de la région Île-de-France. Notre mission est d'accompagner les entreprises internationales dans leur développement ou leur implantation dans notre région. Nous aidons ainsi chaque année 1200 entreprises à construire des partenariats technologiques et d'affaires et à élaborer des stratégies de croissance en Île-de-France. Donc, comme l'ont dit Zahira et Cécile, nous avons le plaisir d'accueillir Regis et Carmen, tous deux tax partners, France pour Regis et US pour Carmen du cabinet Ernst Young, qui vont animer cette session. De plus, Regis est également board member de l'AmCham France. Donc, cette session sera suivie d'un échange de questions-réponses. Donc, n'hésitez pas à poser vos questions dans le chat, en français ou en anglais, c'est comme vous préférez. Et on se retrouve pour la conclusion. Mais de tout de suite, retour à l'anglais et à Cécile.
Thank you, merci. Thank you, Sandrine. Just, I realized that some of you can access the presentation, so please don't click on the presentation because everybody can see it. Thank you, thank you. A few key figures about the Paris region. It's the first tech and business ecosystem in Europe with cluster in every industries. It's the third world's highest concentration of Fortune 500 headquarters. It's the first European region in terms of R&D expenditures. And with its central location, it gives access to a market of 500 million consumers. So that was a few words for those who are not really familiar with our region. And I'll now let the mic to you, Regis, for getting to the subject.
Thank you very much, Cécile. So I have moved the slides. So Regis Houriez, tax partner of EY based in Paris. Good afternoon and good morning for all the US people that are connected today. I am very first delighted to introduce Carmen Encarnacion, our US dedicated tax partner based in Paris for 1 year. Carmen, do you want to say a word on you and why you are based in Paris and how does it feel since 1 year?
Absolutely. Very delighted to be part of this session. Thank you so much for the invitation. As Regis mentioned, I recently joined the EY Paris practice, and we just opened a US desk that is intended to essentially bridge the gap between any businesses between the US and France, and more broadly, any pan-European activity. So essentially, the mission of the US desk, obviously in full collaboration with the partners of EY France, including Regis, is to have a representation of or assist US multinationals that will have investments or that currently have investments in Europe, and also assist pan-European clients, specifically French multinationals that have investments or are expecting to invest in the US. So it's a dual role. And hopefully through that role, we will be able to add a lot of value to the market and obviously team up with AmCham and Paris and Choose Paris.
Okay, thank you, Carmen. So you can see on the screen the agenda for today. So we will start first with an overview of the US tax regime. Here, we don't want to simply compare US with France. We simply want to highlight what are the key tax considerations that a US company, either a privately held or a listed company, so it's not only the big multinationals, what would be the key tax consideration they would have in mind when looking first to invest abroad, outside the US, and specifically in France. And also, Carmen will drive us through a bit of an update of the state and local taxation framework in the US, because we will talk a lot about corporate income tax, but there is not only a corporate income tax, there are a lot of other taxation that are considered by investor when growing a business. For the second part of the presentation, we will focus on overview of the French tax framework for US company investing in France. So we will go through corporate income tax, not only the tax rate, but also the general framework. We will benchmark the French R&D tax credit regime against the US and some other country regime. We will look at the French local taxes update, including the latest legislative changes. And finally, because there is not only a tax consideration for investing abroad, and especially in France, we will go through the various non-tax incentives, grants and incentives that are available for you to invest in France at the EU level, the French state level, but also, most importantly, and Sandrine will go through the aids that are made available by the Île-de-France region. So let's start with the US. Carmen, the floor is yours. I'm shifting to your slide and you can take then the control.
Great. Thank you very much, Regis. So basically what I want to try to do is provide a very broad framework of what the US tax system is, not only from a corporate income tax perspective, but thinking more broadly about international investment. So thinking about what happens when a US multinational invests into France, what are the considerations that we need to take into account? And also, as Regis mentioned, we're going to talk about some state and local considerations that are also relevant, and that in many cases, investors do not consider when modeling out the impact or the cost associated with investing into the US. But before that, maybe just to spice things up a little bit, I want to just talk very briefly about the midterm elections and the consequences that might have in terms of legislative updates in the US. And as you know, tomorrow we have a midterm elections, or it's the last day. And the implications could be significant in terms of what could result from these elections and the impact that it might have in tax legislation. As you know, President Biden had a very ambitious tax agenda that it wanted to propose through the Build Back Better plan. And unfortunately, that tax agenda was not able to go through, particularly because not only didn't they have the support of the Republicans, but also within the Democrats, they didn't have sufficient support to be able to pass a robust legislation of that nature. So they had to scale it down, and they were able to pass the Inflation Reduction Act, which includes certain provisions from a tax perspective, but overall did not overhaul or did not modify significantly the Tax Jobs and Cuts Act reform that was implemented or introduced by President Donald Trump. So as you can see from this slide, it has a lot of information, and I'll just pick and choose some relevant points that you need to consider when investing. When a US company is investing into France, what are those considerations? But this is a framework that is mostly driven by the tax reform of Donald Trump, which was enacted into law in 2018. As you well recall, the corporate income tax rate in the US was 35%. And with the reform of 2018, it was reduced to 21%. This was significant in terms of having a mindset of trying to attract investment into the US and bringing the US to being a more competitive jurisdiction when compared to OECD countries. Then, in addition to that, it introduced additional incentives such as the foreign-derived intangible income. And what is this about? It's essentially, in a very practical manner, it's making the US be a export flat platform. So to the extent that the US, either a subsidiary, so if you're a French multinational with an investment in the US, or a US multinational that has presence worldwide, to the extent that you're rendering services abroad, or you are extending a license by means of which you receive a royalty payment, or you're selling goods abroad, that can result in a reduced tax rate, which right now would be effective of 13.1 to 5. So in essence, if you blend the 21 corporate income tax rate with this 13.1 to 5%, you get a very attractive rate when you compare it with the rest of the landscape worldwide in terms of corporate income tax. And then in addition to that, you have a series of additional incentives that were introduced. And it's very funny how the way that the legislative history explains it in the term that it talks about carrots and sticks. So the carrots, the treats that were granted as a result of the tax reform were in addition bonus depreciation. So we have a accelerated depreciation of 100% year one. So if you acquire fixed assets, and to the extent they're not acquired from a related party, so they're just new acquisitions and they're put in place, they can be fully deducted in year one. That a benefit is being scaled down, but the expectation is that there will be negotiations to expand that benefit further. The same happens with respect to R&D, so significant depreciation, amortization deductions that could be of benefit to investments into the US as a result of the reform. So if you see, the general trait is that they were trying to make the US more attractive, more competitive, with the intention of attracting investment into the US and also bringing back a lot of the investment from US multinationals that had gone abroad. So as you recall, the Amazons, the Googles of the world had essentially parked a lot of their intangible property, a lot of their manufacturing activity outside of the US. And this was a way to essentially try to promote or recover that investment back into the US. And in terms of the stakes, so obviously there was a trade or a balance between the good things and the bad things of the reform, but a lot of those bad things are pretty much aligned with OECD principles and aligned with what other European countries, including France, has adopted. So for instance, the famous, and obviously I will not bore you with sections of the code, but in general terms, limitations on interest deductibility. So that's the famous 163J. If you ever hear as part of a due diligence or as part of any discussions around US tax, there will likely be limitations the amount of interest that you can deduct to the extent they exceed a certain amount over your EBITDA. So if you leverage a company in the US and it exceeds 30% of your EBITDA, and now actually your EBIT, you will see that there will be a limitation in the amount of the interest that you can deduct. Importantly, this is not a permanent difference, so they will not disallow the deductibility of those interests perpetually, but rather you can correct the ratio, and therefore you would be in a position to effectively deduct those interests. In addition to that, very similar to other jurisdictions, there's passive income rules. So basically, and very practically speaking, if a US entity has investments in France, there's different ways in which it can structure those investments. If it has 100% wholly owned subsidiary, French wholly owned subsidiary, then that French subsidiary, you look into the activities of that entity. If they are passive in nature, then you essentially are going to have income that will be included on a yearly basis at the level of the US parent company and taxed in the US. Obviously, you can benefit from the taxes paid in France so that, or to avoid double taxation. Then you're going to have active income that is also going to be taxed on a yearly basis at a rate that is 10.5%. This is the famous GILTI inclusion. And so as you can see, what the US is trying to do is make sure that it covers all of the net, all of the income that is generated by the entity, not only within the US, but also outside of the US. And it guarantees that there's no double tax by allowing certain foreign tax credits in order to mitigate double taxation. Obviously, the US tax system is extremely sophisticated and complicated, and I'm not going to bore you at this point with all of the details, but there can be situations where double taxation can arrive due to the certain regulations that the US has introduced, whereby there are restrictions, significant restrictions to the use of credits. So that's a framework, a very general framework of the US. But then in addition to that, and this is talking about international and federal, you have state and local taxes. And every state is a different universe. So you, in addition to considering the potential implications from a federal and international tax perspective, you also have to look at the potential implications at a state and local level. So you're going to face situations where, depending on the state, you're going to have income taxes or not. You're going to have franchise taxes. You're going to have gross receipts taxes. You're going to have sales, which is very similar to the VAT. You're going to have property taxes, employment taxes, and transfer taxes. So depending on the state, you need to consider the potential implications, which obviously can increase your, one, effective tax rate, and two, your cost associated with operating in that state. And this is a slide that has a lot of information. The reason why we wanted to put so much information was just so that you can digest it on your own and just have an illustrative of how a state, in this case California, would tax your operations. But in very general terms, what the states are looking at is, where are the customers? Where are the sales activities? Where are the assets located? Where are the employees located? So those are factors that states are going to look at to determine whether they, each of them, have the right to tax. So in the case of California, it is very much driven by sales. So if the customer is in California, California will likely claim a nexus. That is the term that is used to say, hey, the piece of that pie, there's a part of the piece of the pie that needs to be taxed by California. And as I indicated, there are different taxes that can apply at a state and local level. In the case of California, the most important are sales and use taxes, property taxes, and employment taxes. Obviously, if you look at other states, for example, if you think about Florida or Texas, they will tell you, well, we want to attract investment, so we're not going to apply income taxes, state income taxes. So depending on where you operate, one, and depending where you have activities whatsoever, meaning if you have sales, if you have customers, if you have employees located in that specific state, you might have implications resulting from those operations. That is, in general terms, what I wanted to discuss. Obviously, a lot more detail from a US perspective, and happy to address any questions that you might have. Regis, with that, I turn it to you.
Thank you, Carmen, for that comprehensive overview. So obviously, the US tax regime is very complex, and there are a lot of difference to what is applicable to a French subsidiary of a US group. But at the same time, we will see that there are similarities between both, and especially the corporate income tax side, the federal view, and the state and local tax view, which is also a bit the same here in France. So if we start with the French corporate income tax update, I think the overview of the CIT rate is very important. So it's the below the line perspective. Of course, a lot of business are looking at investment based on EBITDA, but at the end of the day, the below the line CIT adjustment is critical. So you mentioned 19% in the US as a corporate income tax rate. The good news in France, and many of you are already aware that since 2017, under the leadership of President Macron, the strategy has really been to make France much more attractive for business at large. And that has started with aligning the French corporate income tax rate with the average of OECD mature market. And it has been done progressively over the period 2018 to 2022. So starting from 33.33, the normal statutory rate, you can see that now for financial year open as from January 1st, 2022, the rate is at 25%. In fact, it's a little bit more because there is a 3.3% surcharge in addition of that rate, which makes a blended effective tax rate of 25.8%. So it is much more competitive, and you see the French column in blue on the right side, but in fact it could be in the middle side, just to close China, because China, Brazil, Spain, India, you can see Belgium and Netherlands is even higher. So we are really now in the average. The rate is stable. We don't expect it's going to change, at least during the next 4 years, where President Macron will finish his second mandate. Of course, there are some discussion about potentially taxing exceptional profits, but so far France is more looking at the EU approach rather than increasing the corporate income tax rate. And what I want to mention at that stage is that since the last 5 years, we have seen a lot of countries have been reducing CIT rate, and they are coming to a stage now where they don't have any more traction to do further reduction. And because of the financial and budget constraints, the rates are stable on CIT, I would say. It's difficult to increase VAT, as that would shift the burden on the end user. So the landscape for the tax competition in Europe now is really more on the grants and incentive and the tax credit space. And we will see during the presentation that France is relatively well placed in that field also. If I move a little bit further and we stop talking about CIT rate, I think here in one pager, you have really the key consideration for US companies investing into France. So ordinary income, business income, the tax rate we have just seen is 25%. It must be noticed that we have a patent box regime, which is basically allowing to tax at a reduced rate of 10% the income derived from the licensing of IP assets and sometimes from the sales of IP assets that are eligible to that reduced rate of taxation. So the so-called IP patent box regime in France, it's a very powerful regime for groups that decide to locate and grow IP in France, because the regime is available only if you follow a nexus approach. So it must be linked to R&D activity conducted by the French subsidiary. If you accept to go into that approach rather than keeping the IP, let's say, in the US, if you accept that approach, then you have a very competitive rate of 10% applicable in France, which can be combined with a full deduction at 25% of the normal expense of the company, like, for example, the amortization of the R&D equipment. And that can also be combined with the eligibility to the French R&D tax credit regime that we will discuss later on. So this one has to be reminded as being very attractive. In the general themes box below, we are addressing all our tax cross-border flows between France and the US, especially on interest payment from France to the US, dividend from France to the US, and royalties. So here, basically, it's very attractive because under French domestic law, there is a withholding tax exemption on interest expense paid to the US. And if you refer to the French-US tax treaty that was amended back in 2007, there is generally a 0% rate available on dividend paid to the US and royalty paid to the US by fully owned subsidiaries of US group active in France. So there is no tax leakage at all generally when repatriating or having cash flows between France and the US. If you look at exceptional income generated by a French subsidiary, so typically dividend and capital gain, so we have the equivalent of participation exemption regime in France. So if you think about a subsidiary of a US parent that would own shares in other entities, for example, in Europe as a holding entity in Europe, capital gain on selling shares in those companies after 2 years ownership would basically be 88% exempt from CIT, which means that only 12% of the capital gain will be subject to tax at 25%. So that makes a quite attractive effective tax rate of 3.1% on capital gain. So yes, it is still 3.1%. So it is more than what we can achieve in other countries in Europe, like Luxembourg or the Netherlands. But still, combined with the other incentive, it remains competitive. And for dividend, the exemption is even higher because it can be either 95% exemption in basis or 99% exemption in basis on dividend income received by a French subsidiaries within a French tax consolidation. So in that case, the effective tax rate on dividend income is really coming down to either 1.7% or even 0.3% if you pay dividend within a French tax group. The general themes continued. So in the middle column, I mentioned tax-free reorganization regime. So it's all about a merger, spin-off, partial contribution of assets or partial demerger. But basically, the way France has implemented the EU merger tax directive is very efficient. And it is basically possible under certain conditions, but it's quite often available to do a merger operation or separation operation in France, totally tax-free, so without any transfer tax, registration duty, or capital gain tax, so it's a tax deferral regime. I mentioned the point because it's very popular for US group that are not looking to invest in France, but that are already active in France. And when they make acquisition of additional French companies, then it's a very efficient way to combine the French companies all together into, for example, one single legal entity. We have a tax consolidation regime available. So if you have different companies in France that are all 95% owned, you can form one single tax unity. Therefore, you will consolidate losses and profit, simplify the taxation of flows between the companies member of the tax group, which is always efficient, especially if you can create debt into that tax group for, let's say, finance investment or make acquisition, because in that case, the interest expense can be offset against the operating profit of the other entities of the tax group. And we have also available VAT grouping, which is the equivalent of tax consolidation that can bring some cash tax benefit to US multinationals. We talked a bit with Carmen about interest limitation. In the US, I think you mentioned it's an EBITDA limitation. It's the same concept in France. As you can see, we have basically the general principle is that up to 30% of the tax EBITDA interest expense are allowed. And it's very efficient under tax grouping because you refer to the EBITDA of the entire tax group, which is generally higher than a single entity approach. Transfer tax on sale of shares is relatively easy to avoid, notably if you transfer shares within the same group, there is a general exemption available. Want to mention also that the tax losses in France can be carried forward indefinitely. There is no time limitation. There is a limitation on the quantum that you can offset, which is basically within the limit of 1 million euro and above. It's only 50% of the tax losses that can be carried forward, but there is no time limitation. So at the end of the period, all the tax losses can be used, which is quite popular in the US because it is usually possible to have a full deferred tax assets for French tax losses without any time limitation consideration. If we move to the column on the right side, I mean, the miscellaneous matters, I will not go into the details, but transfer pricing, France is really aligned on the international standards. So there is nothing really special to mention there. The tax compliance process is relatively friendly. We are using e-filing. We have quarterly installment payments similar to what is existing in the US. We can talk a bit about the last point, the collaborative and open relation with the tax authorities. You may remember that in the period 2015, 2020, there has been a bit of tension for US groups operating in France. Some people in the press used, the term of US company bashing because of quite strict and aggressive tax audit focusing on US taxpayer. I think it's partially right, partially wrong. There has been indeed on the digital digitalized business and big corporations some tough tax audit that were conducted at that time, but it was not specific to France. There has been the same kind of experience in other countries like Italy. It was also a point of time where the US company have to really embrace the OECD and BEPS reform I think all of this is behind us today, and the tax authorities are very open to business for the US companies. The tax audit are going under the normal way for US group, or they are for German or UK or any kind of HQ of origin. We have many advanced schooling procedure in France that the US group can activate if they want to secure in advance or comfort tax position, either on the benefit of a specific tax-free reorg regime or whether to qualify on a permanent establishment in France. There is also a trusted business relationship program that is in place in France for now roughly 4 or 5 years. It is not as popular as the one that are available in other countries like the Netherlands, but some US group have been looking at it actually, and it brings some value. So typically, I would say the tax authorities in France are relatively sophisticated. They are well equipped. They can be tough, yes, depending on tax inspector, but my experience is that it's much more stable and predictable to what you could see in some other countries. I mean, I will not talk about Brazil or Poland, for example, where you have some very aggressive and innovative tax audit. So I thought it was worth to spend a bit of time on that overview to give you the full picture on the corporate income tax, so the below the line position for your French operation in France. The last one I wanted to talk about, which is quite famous and very attractive, notably to the US group, is the French R&D tax credit regime. So basically, here it's a tax credit, so it does not help the US to reduce the effective tax rate. It's simply a way to limit the cash tax out payment, so the amount of cash that you have to get out of the company to pay the corporate income tax. So basically, if you have in France eligible expense that are typically fixed amortization or most of the time engineers, R&D employees, salaries and costs that are spending time in France on eligible projects. So that would be R&D activity that has a sufficient level of innovation. So that is going beyond the state of the art, facing technical blockers and uncertainty. Then the cost of those people are basically eligible to the R&D tax credit regime. And to make it very simple, the tax credit is equal to 30%, 30, of the eligible expense. So it's 30% of all the engineers and employees working on R&D project that would be located in France, including amortization cost as well. And not that there is no limitation, there is no cap. I mean, there is in fact one cap, but it is for eligible expense that are above 100 million euro per year. So a very few number of taxpayers in France. So below, there is almost no cap. And the credit amount is basically receivable against the tax treasury that the French company can use to pay and offset corporate income tax. So that reduces the cash out payment. Also, the nice thing here is that if there are no sufficient profits in France to offset the credit, it is refundable after a 3-year period, so refundable in cash. And before that, the receivable can be even mobilized, which is sold to financial institutions or like banks. And here we compare into that slide the US and the French R&D tax rate regime, because a lot of our clients and a lot of the US group we see, they combine both R&D credit regime in France and also, of course, in the US. And in the US, the French credit is viewed as a subsidy for US GAAP purposes because it is refundable after 3 years. So it is a book above line, which is improving the P&L. Another important point is that to be eligible, the French subsidiary does not have to own the IP, the intellectual property resulting from the R&D activity conducted in France. So it means basically that the French subsidiary of the US parent can provide R&D as a service to the US group, and basically recharging its cost with a markup, so making a good and normal profit on the R&D activity, but not owing as a legal owner of the IP. So that is also very attractive for US group to combine with the US tax regime. And by the way, I have had several experiences, notably for clients from the West Coast region in California, where we all know that the cost of labor is very high, the cost of living is very high, the loyalty of the engineers is very low, almost changing of employers every 2-3 years, if not every year. And a lot of my clients, they were really looking at a place outside the US where they could get R&D employees in a stable and attractive environment, and that would be happy to live there. And clearly, France was on the top of the list in terms of also talent retention and attractivity. So that was to say a word about the French R&D credit regime. The next slide is interesting because it benchmarks also the French R&D credit regime with the other similar regime that you will find in, let's say, normally in Europe. So because a US company may look at France, of course, but also some other countries where we have similar credit regime. So, for example, there is one quite attractive in Spain. We have also one in the Nordics, one in the UK, one in Australia, South Africa, and so on. But if you compare at the end of the day, here you have the survey compare the labor cost at 100 before and after the R&D credit, and you can see that France, with a net cost of 71, is very attractive in that respect. And if you remember my point just before on the possibility to combine the R&D credit regime with a reduced rate of taxation or IP box, it makes it even more attractive. So with those slides, I think we have been through the full picture of the French corporate income tax landscape. If we go on the local taxes landscape, so similar to what we see in the US, but I think we are more simple and less complex than the federal layers we have in the US. But we have like 3 kinds of local taxes. And the good news for business is that for all those taxes, the rates have been going significantly down during the last 3 years, and it is going to continue. So the first one, the property tax, so-called taxe foncière, is a tax due by the owner of real estate assets. So if the US is in a lessee position, the cost will be recharged by the owner. And you can see here the rates are voted by the municipalities, but the taxable bases are defined by law. And for industrial premises like plant, the taxable basis is basically a fixed percentage of the book value of the construction costs. So the good news is that the basis has reduced by 50% in the last years. It came down from 8% to 4%, which is also a good element for investor into France. The second one on the right side, the BCP, so business contribution on property, so-called CFE en français. is a bit similar. It's not due by the owner of the assets, it's due by the person that operates and uses the assets. The taxable basis is a bit the same, and the rental value and the rates are voted by the municipalities. I have to mention at that stage that for US company looking to create new plants in France or new logistics center, for example, it is possible as part of grants and incentive negotiated with the municipality to ask for a reduction on the local rates that are voted every year by the municipality. And we have seen for some significant investment, some municipalities in France taking the option to reduce the rate to make the territory more attractive. The last one, I think it's going to be very short. So the BCAV, we call contribution assise sur la valeur ajoutée. So this one is basically going to disappear. So it's a good news because it was basically a tax assessed on gross margin, which has always been very suspect for the US companies because gross margin is close to income or net income. So is it similar to corporate income tax or not? It was never has been very clear, and it was basically a percentage of 1.5% marginal percentage applied to that so-called gross margin. And it was very painful to everybody, including French HQ, because the gross margin was defined with a lot of restriction on expense deduction, and the rate was very high. So the good news is that the rate has been reduced from 1.5 to 0.75% back in 2021. And under the draft finance bill for 2023, so that's mentioned on the right column, there is a provision that has already been voted by the first chamber court of the parliament that is basically reducing the rate by 50% in 2023, and the tax will totally disappear in 2024. So that's the plan. It's pretty certain that it will be voted by the end of the year. So we cross finger, but normally that should be a tax belonging to the past for any US companies looking at investment into France. So that gives you the perspective of the local tax position. VAT rate I mentioned is 20% for most of the sales. There are some reduced rate as in other EU countries. So that is closing the overview of the French tax framework for corporation. A lot of information in a very few minutes. So we're happy to take all your questions, of course, and you can follow up with us after the webcast for sure. We wanted to spend a bit of important time as well on non-tax matter, because when you decide to invest into a country, it's not only based on tax consideration, and especially local tax or corporate income tax. And here we just want you to be fully aware that in Europe, in general, and in France in particular, there are some significant amount of public financing available for investment into eligible programs. And they are eligible and available to US group as they are to French group. So you see here the EU perspective. Yes, you can believe in the amount you have in front of you. That's the true amount of the EU funding available. So hundreds billion, depending on the program. You can see looking at energy, modernization, innovation, environment, and climate. So everything is captured. It is possible to elect for those programs for US company investing in France. The US companies that are benefiting from those aids are public. I mean, it's public listed on the site, so you can see. I can give you some names like Procter & Gamble, Caterpillar, GE, Goodyear's. They have all elected and they have been awarded EU funding for new investment in France, either new plants or modernization of plants. That's the EU perspective. There is also a EU program on the digital activity, and notably for the cloud, for the 5G, 6G. Also, a lot of companies are investing into those programs. Sometimes in collaborative R&D, so where you are active with a consortium, so not single entity program. This is then declined and applied also at the country level. So here you have in one slide the aids that are available at the French state level, on top and in addition of the EU part of the funding allocated to investment into France. And you can see it's a very ambitious plan, so-called the 2030 growth plan, 55 billion investment, 3 to 4 billion immediately this year. And you can see what is being targeted here. So it's all around energy, green hydrogen, nuclear business, electric hybridity, a lot of different field of play where I think the US company will be able to find what they are looking at. And it's real life, very easily available. Of course, there are some procedure to go through, but they are here. And last but not least, if you invest, it should be in Paris and the greater Paris area. And I give you back the lead, Cécile, because in Ile-de-France, there are a lot also of grants and incentives that are available and granted by the region.
Yes, a quick overview of those. The Paris region has three major financial solutions in grants. So the first is PMUP, that is up to 250,000 euros for small companies registered for less than 2 years and with great job potential. The second is InnovUp, that is up to 500,000 euros in grants and 3 million in recoverable advances for innovative projects doing R&D. And the last is for large project that is up to 5 million euros for major R&D projects. So these are the financial solutions, but we have also specific support in industries that represent major stake. So for example, a ready-to-use manufacturing site with lighter administrative procedures. We have support in the hydrogen industry to support the transition to clean energies, some support in the quantum computing to promote research and innovation and collaboration between startups and major industrial groups, and AI for Health challenge that is launched every 2 years. So next year will be one. But just to let you know that we keep track of all new accessible incentives over time. And if you think your company's project fits with one of these incentives, we will be happy to continue the conversation individually after the webinar.
Yeah.
So yeah, that was it for me. Yes, Regis?
No, I wanted just to give basic illustration of what you just said. I mean, one of our US client last year for a project to develop R&D activities around 5G and 6G. So a client investing US $1 million has got a subsidy from the BPI of $5 million, which is refundable at the end, but you can see the proportion. It's a significant amount to fund the project. And similarly, for a new plant creation, with a 150 million euro investment by the US client, the total amount of financial aids and subsidy that included also access to lands and building at attractive price, totaling 34 million. So 34 million of total aids for 150 million investment project, which is just to give you an illustration of the potentiality and the willingness, in fact, of the Paris region and all the French government to attract business on the territory.
Yes. Thank you. And maybe we have a few minutes to answer. There was just one question I saw in the chat. that was more from Juan, that was looking to understand the vocabulary, and the question is, what would be the name of a lecture to understand all the vocabulary you told Regis? I don't know if you can see the question in the chat.
Right. So there was a specific question about specific terms, tax terms in the U.S. Probably the best ways that we can facilitate some materials, some specific brochures where we lay out those terms and explain a little bit further what they entail. So we can probably send that over to Shrewsbury's and AmSham, and you can circulate it amongst the members of this club.
Great, perfect, Carmen.
I think we can circulate also a link to access the EY US Worldwide Corporate Tax Guide. Where I think you have a good definition of the acronyms as well. Maybe one question for you, Carmen. You mentioned a lot of tax reform, but I have seen recently enacted in the US the CHIPS Act, which is a huge investment and financing by the US government for chips-related industry to relocate to the US. Do you think it's a big game changer, and what kind of implication it could have, you think, on US company investing in the chips industry outside the US?
So it's a very interesting question, Regis, because obviously there's a significant amount of incentives and money that has been put into this bill. And the intention obviously was to promote the creation of microprocessing factories into the US. And by giving a significant amount of investments. But the big question is, and obviously remember that the intention here was to try to discourage China's uncompetitiveness. So it was a game of trades. And so the question here is whether now, by introducing this significant incentives to US entities that are engaging in manufacturing activity within the US, whether we are breaching trade laws. So that is a question that is out there that is being discussed significantly at the level of the World Trade Organization, whether these subsidies are really legitimate in the context of world trade. And obviously that could result, and there has been significant speculation about whether that could result in retaliation by other countries, or putting measures into avoiding this type of disparities in the treatment of US manufacturing versus worldwide manufacturing.
Okay, thanks. Very clear.
Yeah, absolutely.
Thanks. Maybe if you have 2 minutes, we have a last question from Guy. He wanted to know how much this extend to Canadian companies, and demonstrated in open bidding 30%, added lossless image and video compression from optimization. I don't know, it's very specific, but it's in digital imaging. So I don't know if...
Yeah, I can see the point, but I think everything we have described, Guy, is not specific to the US. So the tax treaty between France and Canada is, I think, very attractive, maybe not as attractive as the French-US one, but very close. And the R&D tax credit regime apply exactly the same. And by the way, there is a lot of cross-border flows in R&D between France and Canada, and not only in the video game industry.
Great. So I think we are at the end of this webinar. We will send you, I'm talking to the participants, so the presentation and the guide from EY that you mentioned, Regis. Thank you very much, Regis and Carmen, for your time and for sharing your expertise with us today. Thank you everyone for attending. And we will send you also our contacts, so if you have any question and or would like to set up a following conversation, following up call, we will be more than happy. Thank you everyone, and have a nice end of the day or day, depending on where you are in the world right now.
Okay.
Everywhere.
Goodbye.
Thank you. Bye bye.